Hey, Patrick Sander here, Landing Financial Group. Brandi and I this morning wanted to talk to you a little bit about the stock market. Everybody thinks it's so confusing that a lot of people just don't do anything with the stock market at all. And I enjoy having conversations with them to basically explain the basics. And I'll go back to talking about cell phones, okay? Originally, cell phones came out and they placed phone calls, right? Over time, cell phones have gotten so crazy that they're extremely difficult for me to understand. They do everything from cameras to GPS to getting information, full computer systems, you name it, right? And it's really kind of difficult sometimes just to see if you even want to make a phone call, how to do just that. My mom is 93, absolutely wanted to have an iPhone, got an iPhone. Very, very confusing to her to try and figure out how to use that iPhone. And that's, I think, what happens within the stock market too. And so a lot of times people have opportunities within their 401k or their government plans. They can have IRAs, they can have Roth IRAs, and all these different opportunities to save for their retirement, tax options, tax opportunities, and yet they don't because they're a little confused. So let's go back and just explain the stock market in basic terms, okay? The stock market is set up to bring a lender together with a borrower. That's it. If you have the money, you are the lender, and you're just looking for somebody who's going to borrow your money. And you want to try and go through and do that in a situation that is the least amount of risk for the most return, right? So inside the stock market, there's only two investments. There's stocks and there's bonds. It's all these other entities that have come along that have clouded it and made it so confusing to now understand, should I be in mutual funds? Should I be in ETF? Should I be doing options? Should I day trade? Should I buy and hold? What should I? Yeah, let's go back to stocks and bonds. Bonds are pretty simple. It's a contractual agreement between you and a borrower that wants to go through and borrow your money for a set period of time. And they're going to go through and do a certain amount of interest for that period of time. You're going to get those payments usually as a quarterly payment. And upon the time of completion, you're going to get all the money back, or you're going to renegotiate and see if you want to do another bond with that entity. And a lot of times people say, well, who would want to borrow money? Who would want to borrow money as far as mine? Well, a lot of large companies, you have Walmart, Pepsi, anybody that you can really think of that has inventory and personnel. They want to go through and borrow that money because they can borrow your money for less interest than they can get on their own investments. Hey, that's a key there, is always go through, and if you can borrow somebody else's money at less interest than you can get on your interest of your investment, always borrow somebody else's money. And that's what these large companies like to go through and do, is borrow the money from individuals who want to do bonds so they can pay their payroll, pay their inventory, cover their inventory costs, and go through and make more money on their own investments. So they're willing to go through and do these negotiated terms. Now, if that company were to falter, fail, go out of business, what's kind of interesting is where you're at in the totem pole. Very first payout that the company has to do if they're going out is they have to cover their last payroll. Then they have to go through and cover any type of government banks or government loans that they have. Next comes down to the bondholders. So bondholders are basically third in place to go through and receive their money back. And then everything falls underneath that, from the IRS to the vendors to any other shareholders that are below that bond status will get paid back as the money still exists as they're going out. Okay. So of course there is risk at buying a bond because the company may go out of business or may not be able to pay. So that's why you want to pick a bond that is of decent structure or the company has a great history. Right. Next is a stock. And the stock is pretty easy to understand also. Most people have bought a house, and I like to explain it this way. If you've bought a house and you've bought a piece of stock in real estate, right? And as soon as you buy that, the whole goal is to try and keep the value of that house up, to do improvements, to do maintenance, and just to let time pass by, because inflation continues on, and usually that house will be worth more in the future than it is today, and you'll want to sell it for more than you originally bought it for. So that's basically what a stock is. You want to pick a company that's going to do just that. It's going to improve their products. They're going to continue to keep doing business. They're going to up the value of their holdings because of just the fact of invention and whatever they're doing to create new business. And just because of inflation and times, it'll probably be worth more later than it is today. So that's the simplicity of stocks and bonds and what makes up the stock market. If you have the opportunity to do business through your job, you probably have mutual funds through your 401k. And that's where things start to get a little bit clouded, is that these mutual funds will group together, like say 30 to 300 companies into one holding. And there's a philosophy behind that mutual fund as to what it is going to do. But it usually does not do any type of major trading where it's looking at, as we go through changing times, whether it be, challenges with war or with pandemics or even taxes or any of these different variables that come through and create volatility to the market. A lot of times the mutual fund won't make major changes to be adequate to that. So it's more of a buy and hold situation. If you're going through and doing stuff on your own, you could go what they consider active management, and you could actually invest directly into the stocks or directly into the bonds on your own, have somebody working with you, or you can make decisions on your own of how to change and move those different things. Like just an example, let's say that fuel prices are going up. I'd heard one time, and I used to be a commercial pilot, so this is kind of what I heard back then, is that if fuel goes up, if the cost of a fuel barrel goes up by 1 penny, it costs the airlines over $800,000 more to fly that day. Okay, so I mean, that's just a thought. If you're in the airline investments and all of a sudden you start hearing that fuel is going up, well, then chances are so are the expenses for the airlines. So maybe it's a thought that it would be a time to sell that airline stock, sell it for a premium, now just basically sit and wait until fuel prices maybe come back down again and buy back in as it's low. Always want to buy in when there is opportunity, and sell at a point to where you believe that there's decent growth, or that you see that you've actually made some money on your return, and then you can always sit and wait to buy back in, and that's really considered active management. The nice thing about retirement plans through work is sometimes the employer will do match contributions, and those match contributions are huge. If they're going to go through and give you 10 cents match or 25-cent match or a 50-cent match, some even do dollar per dollar match. You have to understand that is that percentage of return without even dealing in the market. So if they're going to give you a 25% match, that's 25% rate of return if you stick $1 in there, and you don't even have to have any risk. You can put it in the money market account and at least get that rate of return from work. The other big thing is that if employees don't stay the full period of time and they happen to leave prematurely and they're not fully vested, the portion of money that is not vested rolls back into all the participants that are participating in the 401k. So sometimes on your statement, you might see employer match contribution and then other match contribution, and that's dollars coming from you from people who have actually left service. So it's super important to understand the opportunities that you have between work, maybe what the IRS offers you as far as tax opportunities to invest, and then understand the stock market a little bit better to where you can feel a little bit more comfortable. And I hope that maybe this has helped to give you the basics of the stock market. Go back to the basics of what a phone does. It makes a phone call. And then as you get better and you learn things, maybe you can add on some of the other features and the other options, or just stick with the basics. It's been around for a long time. It's going to be around for a long time. And it's great to understand and be able to live that theory of, hey, have your money work for you. You've heard that before. That's how you do it, is one of the ways is through the stock market, allowing it to go through and work for you. It's earning interest as you're doing other things. I hope this has been helpful. You can always contact us if you'd like, 561-229-0009, or you can go to our website at landinggroup.com. Again, I'm Patrick Sandner. Thanks for listening.